For asset repositioning, over 90% of Americans have their capital tied up in two places. It's either in trapped equity in their primary residence, or it's in government-sponsored qualified plans, such as 401ks and IRAs. And in the trapped equity in your primary residence, I think what a lot of people don't realize is, do you know what the rate of return is on your trapped equity? It's actually zero. You're getting a 0% return on that equity in your house. The only time that gets converted into something is when you actually sell your house. So if you can take out a home equity line of credit or something of that nature and redeploy some of that capital into anything from, let's say, an infinite banking policy, one of these other low risk alternative assets like real estate, for instance, where you can grow your money kind of tax free, even if you offset, even at today's interest rates, right? You can still be making, on average, most of our alternative investments are making over 20%. So if you're taking out funds at whatever the rate is, say 6-7%, you still have quite a healthy arbitrage there in terms of how your money is growing, better for you. And in addition, you actually increase the amount of tax deductible amount that you can use on that mortgage for the home equity line of credit. Right? So you're reducing your taxes by using that, right? So that's how you could think of the investment, right? And using multiple strategies in one overarching theme that's going to take you to the next level, right? And get you higher returns, right? On the government-sponsored qualified plans, I became so frustrated with watching my 401k, having absolutely no control over my 401k, and realizing that I could do so much better with alternative investments that I actually created a 401k calculator before I sold mine. So in this scenario, if you take just 100,000 in a 401k and then you leave it in there and you run it out and we average it at about a 7% return, over a 20-year period, that is going to yield 250K. Okay. Now, if you take that same 100K, you pay the 10% taxes, then let's even say you're in a 35% tax bracket. So now you have a net investable 55K. You take that 55K and put that into real estate or an alternative asset that has a three-dimensional type return profile with tax-free compounding, with forced appreciation growth, right, of 20%. When you compound that over 20 years, that 55K actually becomes over 2 million in value. So it becomes very clear, and you can make your own assumptions, but you can objectively look at this information and say, which investment is better for me? Which is going to outperform? Which has a lower amount of risk?